All right, let's just cut straight to it. There's something really strange happening in the markets right now, and frankly, it should have your full attention. On one hand, you've got this wild AI-fueled party going on. The stocks are hitting all-time highs, and everybody's feeling euphoric. But then you look at the greatest capital allocator of our time, Warren Buffett, and he's doing the exact opposite. He's quietly heading for the exits. He's been selling, not buying, and he's piling up a mountain of cash. So the real question we need to ask isn't just why. It's what is the structural weakness that he sees that almost everyone else is completely ignoring? Let's break it down.
So this number, this is the flashing red light on the dashboard. $382 billion. That is the amount of cash and short-term treasuries Berkshire Hathaway is sitting on right now. Now, to really wrap your head around that number, think about this. That cash pile is bigger than the entire market cap of about 95% of the companies in the S&P 500. It's just a staggering amount of money. So in a market where everyone's screaming that AI is the next gold rush, Buffett is consciously choosing to sit on the sidelines with his dry powder. And you have to understand, this isn't a passive decision. This is a very active, very strategic one. It's a signal.
And this all comes back to his most famous principle, right? This is the core operating system he runs on. Be fearful when others are greedy, and be greedy when others are fearful. So let's just take a look around. Does the market feel fearful to you right now? No way. It feels incredibly greedy. You see it on the news, you see it in the stretched valuations, it's everywhere. So if Buffett's rulebook says to be fearful when others are greedy, what's his logical move? Exactly this. But this isn't him being scared and hiding under the bed. No, this is a cold, rational, calculated response. He sees prices that don't offer any margin of safety, and he's positioning himself for the moment things inevitably swing back to reality.
I mean, just look at this divergence. It's like two different universes. The mainstream story you hear on TV is all about the AI revolution, a new bull market, don't miss out. But then you look at what Buffett is actually doing with his capital, and it tells the complete opposite story. For 11 straight quarters, that's almost 3 years, he has been a net seller of stocks. Now listen, that is not someone trying to time the market for a week or two. That is a long-term, deep-seated thesis that the opportunities available today are just not worth the price. He isn't just playing defense, he's preserving his firepower to go on offense when the real opportunity finally shows up.
So here's how we're going to deconstruct this whole thing. We'll start with the warning signs that Buffett is clearly seeing. Then, we'll dive deep into this idea of two economies that are being pulled apart. We'll pinpoint the specific catalyst on the horizon, this thing called the 2026 debt wall. Then we'll get tactical and lay out the playbook, the power of liquidity. We'll also bust some common myths that trip people up, and then we'll wrap it all together with the core mental model you'll need for the coming decade.
Okay, let's get into the mechanics. The first big concept we absolutely have to get our heads around is this tale of two economies. And look, this isn't just a catchy phrase. It's the core structural imbalance that explains the profound disconnect between the booming stock market and what's actually happening on Main Street for most people.
So think of it like this. On one side, you have the paper economy. This is Wall Street, right? It's stocks, bonds, financial assets whose values are getting more and more detached from reality. And they're being driven by big narratives like AI and, frankly, by monetary policy. Then, on the other side, you have the real economy. This is the world you and I actually live in. It's building things, making things, providing essential services. And here's the problem. The paper economy is absolutely roaring, while the real economy, well, it's starting to show some very real signs of stress, from slowing manufacturing to rising credit card debt.
And this chart right here, it shows you just how out of whack things have become. This is the Buffett indicator. It's a really simple metric. It just compares the total value of the stock market to the size of the actual U.S. economy, our GDP. And right now, the stock market is valued at over 2 times, 200% of the real economy. Now, just for some historical context, anytime this number has even gotten above 120% in the past, it has almost always preceded a major market correction. So at 200%, we are in completely uncharted territory. It's the definition of a valuation bubble.
And look, it's not just one metric that's flashing red. Here's another one. It's got the CAPE ratio. All you need to know is it's another trusted way to measure if the market is cheap or expensive. And right now, it just hit 39.5. Now, why does that number matter? Because there has only been one other time in modern financial history where valuations have been this stretched, and that was at the absolute peak of the dot-com bubble in 2000, right before it all came crashing down. Data is very clear on this. Where you start from is the best predictor of your future returns. And from these levels, the probability of making any real money over the next decade is extremely low.
You know, this whole situation might seem chaotic and random, but it's really not. It's a predictable pattern. The legendary investor Ray Dalio laid this out perfectly in his model of the debt cycle. It works like a machine. First you get the boom. Credit is cheap and easy, everyone's borrowing and asset prices just go up. Then comes the bubble, where sentiment is euphoric and everyone is leveraged to the hilt. That's step 2. Then you get the top, step 3, where prices just look insane compared to any traditional measure. And we are clearly somewhere between phase 2 and 3 right now. So what comes next? Well, step 4 is the fall. It's the deleveraging. It's when the bills come due, and the cost to service all that debt becomes greater than the income coming in. And that's what mechanically triggers forced asset sales.
So that brings us to the big question, right? What's the pin that's going to pop this bubble? What's the specific event that's going to force that deleveraging we just talked about? Well, it isn't some abstract theory. It has a name and it has a date. It's called the 2026 debt wall.
$1.8 trillion. That's the amount of commercial real estate debt. Think office buildings, apartment complexes, shopping malls. That has to be refinanced between now and the end of 2026. Now, here's the absolute critical point. All of this debt was taken out when interest rates were basically at zero. Now, those building owners have to go back to the bank and get a new loan at today's much, much higher rates. For a huge number of these properties, the new mortgage payment is going to be higher than all the rent they collect. The math simply stops working. This is the catalyst.
And this timeline shows you just how urgent this is. This is not some far-off problem for the 2030s. You can see the wave starting to build in 2025, and then in 2026, it crests into a full-blown tidal wave. These maturity dates are locked into contracts. They are non-negotiable deadlines that are going to force a reckoning that can no longer be kicked down the road.
You see, for the last couple of years, the system has relied on a game called extend and pretend. The banks would just extend the loan maturity dates, pretending that the problem would eventually solve itself, but that strategy has officially run out of road. In 2026, with this sheer volume of debt coming due, the game is over. Owners will be faced with 3 terrible choices: sell their asset into a weak market, attempt a painful debt restructuring, or simply default and hand the keys back to the bank. And notice, all 3 of those paths lead to the creation of one very specific type of market participant, the forced seller.
And this quote just nails the entire concept. Market bottoms aren't formed because of some vague feeling of fear on the news. They are formed by a very specific mechanical event. Waves of market participants who have no choice but to sell their assets to cover their debts. And this is exactly the environment and exactly the opportunity that someone like Buffett is patiently waiting for.
So this brings us to the protocol. In every crisis, there is a massive transfer of wealth. If the fundamental problem is an excess of leverage that leads to forced sellers, then the strategic counterposition is to be the provider of liquidity. This is the 2026 to 2030 playbook. It's a framework for being on the right side of that wealth transfer.
In this coming cycle, we have to completely invert the conventional wisdom about cash. For years, it's been a zero-return asset, getting eroded by inflation. Well, it's about to become your most potent offensive weapon. You see, liquidity gives you tactical patience. It gives you the power to say no to overpriced, FOMO-driven deals. It gives you the power to wait for that perfect pitch. And ultimately, it gives you the asymmetric negotiating leverage that only comes when you are the one person at the table who doesn't have to do a deal.
So here is the actionable playbook. It's 3 simple steps. First, you build your war chest. You allocate capital to cash and liquid, short-term treasuries ready to be deployed at a moment's notice. Second, you own real assets. You have to hedge your purchasing power against inflation. And third, you patiently wait for that debt wall to create dislocations, and then you use your war chest to hunt for deals from those forced sellers.
So what constitutes a hard asset in this framework? We're talking about the tangible inputs to the real economy, the things you simply can't print. Energy infrastructure, which is the lifeblood of our entire economy. Industrial metals like copper, which is the absolute bedrock of electrification and the AI data center build-out. These are assets with intrinsic utility whose value is derived from the real economy, not the paper one. They provide a critical hedge while you wait. Now, to actually execute this protocol, it requires you to invert much of the mainstream financial advice you've been taught your whole life. So let's dismantle some of the most pervasive myths, and then let's address the primary systemic risk that comes along with this strategy.
You've heard it a million times. Cash is trash. Well, in the coming cycle, liquidity is sovereignty. It gives you freedom of action. It gives you control. You've also been told you can't time the market. And while that's true, you can't predict the exact top or bottom. You can absolutely prepare for predictable mechanical cycles. And that's exactly what this playbook is designed to do.
But there is a major risk to holding a lot of cash, and it's called financial repression. With governments holding massive amounts of debt, the unspoken policy is to let inflation run a little bit hot, a little bit higher than interest rates. This slowly erodes the real value of their debt over time. The problem is, it also erodes the real value of your cash savings. And this is precisely why step 2, owning hard assets, is a non-negotiable part of this strategy. It's your defense.
So let's synthesize all of this into the core mental model for the next decade. This is about a paradigm shift, from being just a passive investor to achieving true sovereignty over your own capital.
It all boils down to this one simple question. When that debt wall hits, when the dislocations begin and others are forced to liquidate their best assets just to survive, which side of that transaction are you going to be on? Will you be the one forced to sell out of desperation, or will you be the one with the cash ready to buy the opportunity of a generation? The strategic decisions that you make in the next 18 months will very likely determine your financial position for the next 10 years. Thank you for your time, and remember, this analysis is for educational purposes only and does not constitute financial advice. Always do your own due diligence, and please consult with a qualified professional for your specific situation.